To keep yourself updated, subscribe to Indigo Learn and click the bell icon.
Let's discuss some of the questions from your revision test paper for November 2019 exams. The first question is on financial statement of companies. Now in this you would be expected to present the information in the format as per the Companies Act. Now you have information and they have given you both debit balances as well as credit balances. So if you start on the debit side, you have inventory of raw material and finished goods. Now where would you show this? For raw materials, you will take it to cost of material consumed. It will form part of your cost of material consumed. You will not show raw material as changes in inventories, whereas finished goods, whatever you have, this you will compare with closing stock and you will show what is the changes, right? Then your purchases, you will show it separately in your statement of profit and loss. Then you have manufacturing expenses. Will you show these manufacturing expenses on face of profit and loss? No. You will prepare a note and under other expenses, you will show it separately. Salaries and wages, you will show it as a part of your employees cost. Then you have general charges, which again you will show it as a part of other expenses. Interim dividend paid inclusive of dividend distribution tax 27,000. This item, will it come in the profit and loss statement? No, this will not come in the profit and loss statement. This will be shown as an adjustment under reserves and surplus when you talk about profit and loss balance. So from the P&L balance, you will reduce this amount. Then you have building, plant and machinery, furniture, motor vehicles. All these are your items under PPE, tangible assets. You will show it under tangible assets. Then you have stores and spare parts consumed. This also you will show it along with raw material consumed. Raw materials consumed. Then you have investments, current and non-current. These two items will go in the respective places in the balance sheet, where you will show current investments separately, non-current investments separately. Then you have trade receivables. You will show it on the face of balance sheet. Cash and cash equivalents. Now under cash and cash equivalents, for this you will prepare a note to financial statements, right? This will show it separately in the note. Then wherever there are details to be shown, you will prepare a note for that. Wherever details are not required, you will not prepare a note. For example, trade receivables, these can directly come on your face. This can directly come on the face of your balance sheet. Similarly, your current investments, non-current investments, these can come onto your face of the balance sheet. Coming to the credit side, sales, you will show it under revenue. This is your other income, right? Then this profit and loss account 48,000 is nothing but the opening balance of profit and loss account. This you will show it under reserves and surplus. To this you will add current year profit and you will deduct the dividend and dividend distribution tax. Share capital, this is to be shown under share capital under shareholders fund. Then you have secured loans, short term, long term, you will show them appropriately under non-current liabilities and current liabilities. Then you have fixed deposits on the credit side. You have fixed deposits on the credit side, which means these are also your liabilities. Don't think just because fixed deposits they are your assets. Here fixed deposit is the liability for the company. The company would have accepted deposits from the public. So accordingly you will classify it under short term, that is your current liabilities, and the long term part will go under non-current liabilities. Now under which head of non-current liabilities should this be shown? These will form part of your borrowings. So under long-term borrowings, you will show this fixed deposits balance as well. Similarly, under short-term borrowings, you will show fixed deposit balances. Then trade payables, you can directly show on the face of your balance sheet. Now coming to the adjustments, inventory as on 31st March 2019 is given raw material is so much, finished goods is so much. This will be used to compute changes in inventory on one side. This will go to your raw material consumed. Now where will be the second impact? The second impact will be to show these items as assets in the balance sheet under current assets. Again, for this you will need to prepare a note because you have breakup of what is the raw material, what is the finished goods. Then outstanding expenses, manufacturing 67,500. You will add this to your manufacturing expenses. Correspondingly, you will show it under current liabilities as other current liabilities. Then salaries and wages outstanding 4,500. This also will add to the employee cost. Interest accrued on securities 300. Interest accrued on securities 300. Now, whether this interest pertains to the investments held by the company or does it pertain to the deposits that the company has taken. Now we have to make an assumption here. If we say interest accrued, that accrual part comes generally when you are talking about income which has been accrued, which has been earned. If it was something payable on the loans or on the deposits, they would have said interest payable or interest to be provided for or provision for interest to be made. If that was the language, we could have considered it as a part of the liability side. But since it says interest accrued, it is more like earning the income. So this will become part of your income. You will add this to your other income and you will also show it as your current assets under other current assets. Another way to look at this is, since they have not given us interest expense, there is no expenditure related to interest, we can again assume that this part belongs to the earning side or income side and not the expenditure side. Then general charges prepaid 2490. If it is a prepaid thing, you will reduce from the expenses and show it as other current assets. Provide depreciation 2%, 10%, 10% and 20%. For this you need to do two things. Prepare one working note, a small table, and show it along with the tangible asset notes to financial statements. That can be done. Then current maturity of long-term loan is 1000. Now, do we show this as short-term borrowings or do we show this as other current liabilities? We have already understood, if it is a current maturity of a long-term loan, just because it has a current maturity, it does not become a short-term borrowing. So this also forms part of your other current liabilities. Then it says taxation provision of 40% on net profit is to be considered. So whatever profit you get in the statement of profit and loss, 40% will be the tax. Now you may have a question, sir, this is book profit, how can we compute tax on book profit? Friends, this is an accounting paper, this is not your taxation paper. So unless there is any other information given that, okay, this expense is disallowed, this is the rate of depreciation for tax, since we don't have all those information, we'll assume that whatever is the profit as per books of account, on that we'll have to provide for taxes. So you have 40% of whatever profit you get, you'll create a provision for tax, you will show that, and this part will also go under your current liabilities, right? So after you do this, your statement of profit and loss will be prepared and you can prepare the balance sheet along with the notes to financial statements. Your answer will be complete. If these kind of question comes directly in your examination, you should be in a position to score full marks. You should not be losing any mark on this. The next question is to compute effective capital, which is a straightforward question again. What do we need to do? We don't need this authorized information. We need the information of what is the capital. So we'll add preference capital, equity capital, capital reserves, but excluding this revaluation reserve. So out of 195, only 45,000 is what is relevant for us. Then securities premium will definitely add, debentures will definitely add, investment in shares and debentures. What do we do with this? This part we will deduct because the question says that it is a non-investment company. So for a non-investment company, we will always deduct whatever the investments that the company has made, and so you will deduct this 75,000 and P&L debit balance of 1525 also you will deduct, and after that you will arrive at the effective capital. The next question is on cash flow statement, slightly complex, but once you approach this question logically, it will be again a easy question to answer. From the following information, prepare a cash flow statement for the year ended 31st March 2019. Now, as you read the question, we need to figure out, is there some hidden adjustment or is there a possibility some other information that we need to extract. Now, starting with the share capital, you see on 31st March of 2019, it is 3,50,000. Here it is 3 lakhs. Is there an increase? Yes, there is an increase. From 3 lakhs, it has become 350. Now, whether or not we got cash for it, whether we issued shares for free or bonus shares, for that we have to look at the additional information. So far we can see from 3 lakhs, it has become 3,50,000. There is a possible cash inflow of 50,000 on a net basis. Then coming to reserves and surplus, from 38, it has become 82. We do not know on what account it has increased. Again, for this, we will have to check the notes to accounts and additional information. Then trade payables has gone up from 44 to 65. This forms part of your working capital adjustment. Then other current liabilities from 27 it has increased to 37. We need to see what is this information pertaining to. Accordingly, we will have to classify either under the operating activity or under the financing activity. Then short-term provision, that is for tax. For this, we will show it under taxation or income taxes paid under operating activities. Then under non-current assets, we have tangible assets which has increased from 190 to 266. Again, for this we have to see what is the detailed information available. Then intangible assets you can see has come down from 60 to 47. Now goodwill can come down only if it has been amortized, right? Only if it has been amortized, then you will reduce the value of goodwill. So this entry would have been passed in your P&L statement. Then non-current investments from 10,000 it has increased to 35. Current assets, inventory changes, it will go under working capital adjustment. Trade receivables, working capital adjustment. Cash and cash equivalents, opening and closing, we will reconcile that, and this will be represented by cash flow from different activities. Now if you look at the notes given, equity share capital has gone up from 150 to 250. This should trigger in your mind that this is a cash inflow from financing activity. Then from 150 to 1 lakh, there is a reduction in preference share capital, which means this is a cash outflow from financing activity. Come to reserves and surplus. General reserve has gone up from 20,000 to 30,000. Now why has it gone up? We have to check the additional information. If nothing is available, then we can assume it has come from the profit and loss account. 10,000 you have transferred from profit and loss account to the general reserve. Then you have P&L balance of 18 and now you have 27,000. The difference is 9,000, but I cannot say that I have earned 9,000 during the year, because I have to see what all are the various items that has been moved out of this profit and loss account. Maybe dividends have been paid, maybe some amount has been transferred to general reserve. So only after considering all those things we can decide what is the profit we have earned, and we need this number because this will be the starting point for your cash flow statement. Okay. Then you have capital reserve, there was nothing here, now you have 25,000. We have to see how did this balance increase, and based on that we will have to either take a cash inflow if there is any cash inflow, or otherwise it will be a non-cash adjustment. Note 3 of other current liabilities, which is 37,000 and 27,000. This is purely your dividend. This is purely your dividend. When it is your dividend, this will form part of your financing activity. Now once it is a part of financing activity, you will not consider this for your working capital adjustments, right? Then you have tangible assets from 1 lakh, land and building has come down to 75,000. We have to see why has that happened. Then machinery from 90 it has gone to 191. For this we will prepare two ledger statements and figure out what is the impact on the cash flow statement. Now the additional information part. 18,000 depreciation for the year has been written off on plant and machinery. So from plant and machinery you have charged, or on plant and machinery you have charged 18,000 of depreciation. So if you come back, if I prepare a plant and machinery account, what is my balance? My balance is, to balance brought down is 90,000, and there is a depreciation charge of 18,000. This is the information given in the question. Now separately they have not given what is the gross block, what is the net block. We will prepare a single statement. Then on plant and machinery, they say a plant was sold for 12, WDV being 15,000 at the date of sale after charging depreciation. So whatever is the WDV, you have a WDV of 15,000 and that plant was sold for 12,000. Now what does that mean? From this plant and machinery account, plant worth 15,000 was sold and it was sold for 12,000. So what did you get? You got bank, or amount received in bank is 12,000, and you incurred a loss of 3,000, which makes the total to be 15,000. A WDV, plant and machinery worth 15,000 has been sold for 12,000, on which we incurred a loss of 3,000. Again here the segregation between the gross block depreciation is not given, so we can directly pass the entry in the plant and machinery account. So what has been sold? WDV worth 15,000 has been sold. So in effect I have to remove 15,000 from plant and machinery. In bank we got 12,000, by loss 3,000. Both this 12,000 and 3,000 they sum up to 15,000, right? Now you have a closing balance given in the question to be by balance carried down. It's given as 1,91,000. So you have 1,91,000 here. So from 1,91,000 plus 15, that is 2,06,000. 2,06,000 plus 18, 2,24,000 minus 90,000, you have 1,34,000. This is your balancing figure to bank. What does this represent? This represent purchases. Now how do you understand all this information? There is an adjustment of 3,000 of loss which you would have charged to the profit and loss statement, which means it has to be added back because that is not a part of your operating cash flow. Then there is a sale of 12,000 which will be a cash inflow from investing activities, and there is a purchase of 134 which will be a cash outflow from investing activity. So this is how you have to read the question and figure out the hidden information. As you read the question you will understand, yes, there is some adjustment. Looking at the second adjustment, a piece of land has been sold out for 50,000 and balance has been revalued. Profit on such sale and revaluation being transferred to capital reserve. There is no other entry in the capital reserve account. Now what does this mean? Whatever is the profit on sale, that has been transferred to capital reserve. Whatever is the revalued amount, that has been transferred to the capital reserve, and the value that has been sold or the land that has been sold is for 50,000. This is the value of sale of land. Now for preparation of cash flow statement, what is relevant to us? We have to know what is the cash flow from sale. What is the cash flow from sale? Cash flow from sale is 50,000. That is very clear. This is an information which is important or relevant for us to prepare the cash flow statement. The second thing we need to know is what is the profit on land which has been credited to the statement of profit and loss or which has been considered as other income. Is there any profit which has been considered as other income in the statement of profit and loss? The answer to that is no, because the question says whatever is the revaluation and the profit, it has been transferred to the capital reserve. What is the balance in capital reserve? 25,000. So this entire 25,000 represents profit on sale of land and revaluation of balance land. On revaluation anyways there is no cash impact. As far as profit on sale is concerned, we are not concerned with profit on sale in the cash flow statement. What we need is what is the cash inflow from sale of land. What is the cash inflow from sale of land? In this case, cash inflow from sale of land is 50,000. That is what is relevant. Now why am I not bothered about what is the profit on sale of land? The reason is very simple. There is no profit on sale of land which has been taken to the profit and loss account, and because it is not captured in profit and loss account, I do not need that information to make any adjustment. So for me what is relevant is 50,000 of cash inflow, right? Then we have an information that dividend received amounted to 2,100 which included pre-acquisition dividend of 600. What does that mean? There is some investment made, on that we received dividend of 2,100 and it includes a pre-acquisition dividend of 600. This information will be needed to figure out what is the value of fresh investments made. So now if you look at the investment account or investment balances, what is the opening balance? The opening balance is 10,000, then closing balance is 35,000. So let's prepare a ledger account to figure out how much of fresh investment was made. So in the investment account you have the opening balance of 10,000 and you have a closing balance of 35,000. Now the question said that there is a portion of dividend which was pre-acquisition dividend. So if it is a pre-acquisition dividend, what would we have done with that? We would have credited it to investment account. So what is the pre-acquisition amount? The pre-acquisition dividend amount is 600 which will be credited to the investment account. Now, is there any other information? Let's see. It says non-current investment represents investment in shares. Okay, other than that, there is no information relating to non-current investments, which means this is the information we have. With that, we can figure out what is the amount of investment made. So 35,000 plus 600, 35,600 minus 10,000, you get 25,600. This is your balancing figure of purchase. So you will say to bank 25,600. So you have figured out how much is the cash outflow on account of purchase of investments. If you come back to this adjustment, it says dividend received amounted to 2,100 and pre-acquisition is 600, which means post-acquisition is 1,500. Now, if you receive dividend, you will call it a cash inflow from investment activity. Now, should I take cash inflow as 2,100 or should I take cash inflow as 1,500 is the question. Now, you may say, sir, we have already adjusted 600 against the cost of investment, so we should take only 1,500. That is a wrong approach. You have to see what is the total dividend received, which is 2,100. Entire thing becomes an inflow, and on the outflow side you will consider total amount you have paid to acquire those investments, right? Then reading further, an interim dividend of 10,000 including dividend distribution tax has been paid, and amount of provision for tax existing on 31st March 2018 was paid during 2018-19. Now, we have dealt with almost all the adjustments, but we have not yet figured out what is the net profit for the year based on which we can start our cash flow statement. We need to figure out what is the net profit before tax. Now, for that we have to analyze the information given here. If you see the profit and loss account, if you see the P&L account, you have opening balance of 18,000. Always remember, it is a credit balance. P&L balance given under reserves and surplus as a positive amount is a credit balance, and we have a closing balance of 27,000, right? Now, this 25,000 of capital reserve we have already seen has come because of revaluation of land and profit on sale of land. So this information will not impact the profit and loss account. That is one thing. Then the movement of general reserve from 20,000 to 30,000. How much is the increment? The increment or the increase is 10,000. So if I prepare a general reserve account, I have opening balance of 20,000 and I have a closing balance of 30,000, which means 10,000 got added. 10,000 got added or 10,000 got credited to general reserve account, and if no other information is available, this 10,000 would have come from the profit and loss account. So this would have been by P&L account. You would have debited P&L account and you would have got 10,000 in general reserve. So in P&L account you will say to general reserve 10,000. This is another adjustment. Then if you see the dividend declared part, it says on 31st March of 2018 it was 27,000 and on 31st March of 2019 it is 37,000. So there is an increase in dividend payable. Looking at the information, it also says an interim dividend of 10,000 has been paid. Now if you come back, there was a liability of 27,000 and now the liability is 37,000. Generally the assumption is whatever was outstanding as on the previous year, that is balance sheet date, would have been paid in the current year because you cannot keep dividends unpaid. So the assumption will be this 27,000 is paid in the current year. Apart from this, 10,000 of interim dividend has been paid in the current year as interim dividend, and this 37,000 whatever is shown as the closing balance as on 31st March 2019, this would have been the closing balance of dividend payable which has been provided in the current period, right? So if you draw up a dividend payable account, now this is not required in your answer, this is just for our understanding. You had a balance of 27,000. Now you have a balance of 37,000. Generally, the dividend would have been paid, within the prescribed limit under the Companies Act. So it will not be outstanding for a year's time. So you can assume this has been paid. What has been paid? To bank 27,000 has been paid. Now whatever is the closing balance, that would have come from the current year P&L. So by P&L 37,000. This 37,000, whatever is credited to dividend payable account, would have come from your P&L account. So you would say to dividend 37,000, right? To dividend 37,000. That is your final dividend. Apart from this, interim dividend of 10,000 has been paid. Where will that amount come from? That will also come from your P&L account. So to interim dividend 10,000, right? So you have 18,000 on the credit side, and you have 10,000 to general reserve, 10,000 to interim dividend, 37,000 to dividend, and closing balance is 27,000. So what is the balancing figure now? If you have to compute, 10,000 plus 37,000 plus 10,000 plus 27,000 minus 18,000. You get 66,000. So by profit for the year 66,000. Now the same profits can also be determined by preparing a statement. How do we reach at the closing balance from opening balance? We have added the profit, we have reduced the transfers, and we arrived at the closing balance. So you would have had your opening balance, to this you would have added the profits minus all the transfers. This will give you the closing balance. Now if you have to figure out what is the profit for the year, how will you do that? Closing balance minus opening balance plus all the transfers. If you do that, you will get the profit for the period. So what is the closing balance? Closing balance is 27,000. What is the opening balance? Opening balance is 18,000. So you will reduce this. Then you will add back all the transfers. What are the transfers? Transfer to general reserve 10,000, then dividend, final dividend 37,000. Don't take 27,000. 27,000 was last year's. It would have been reduced from profit of last year. The current year dividend is 37,000. Then you have interim dividend of 10,000. Now with this, 27 minus 18 is 9, 9 plus 10, 19, 19 plus 37, 56 plus 10, 66,000. Either ways it is fine. Now this profit that we have arrived at, this is nothing but your profit after tax. Profit after tax. Then how do we get the profit before tax? To this 66,000, you will add whatever is your provision for tax, and it's given in the question. It's given in the question as 32,000, because the question says opening balance of 28,000 has been paid in full, which means this 32,000 represents current year provision only. So from profit after tax, if you add back 32,000 of provision, you get profit before tax of 98,000. Now once you have arrived at this 98,000, the balance part of the problem becomes a simple presentation exercise only. Let us look at the solution. So now we'll begin our answer with net profit before taxation of 98,000 that we have just computed. This part ideally should go as a part of your working note, and you should not show it on the face of the cash flow statement. Okay. So net profit is 98,000. To this we'll have to add items. Now what are the items we have to add? All the non-cash items we need to add. Any item which pertains to other categories, that we need to add. We'll also need to adjust or deduct those items where we have received income but that pertains to some other category. So in short, you will add back the non-cash items and you will adjust for those items which belong to other category, and then finally you will do the working capital changes. Now you have to figure out what are the items to be added. Let's go back to the balance sheet. Now if you look at the balance sheet, for tangible assets we will have depreciation which we will need to adjust. Then for intangible assets from 60 to 47, the goodwill value has come down, which means there is a amortization of 13,000, which is also a non-cash item which needs to be adjusted. On depreciation, if you look at the question, they have mentioned that 18,000 of depreciation for the year has been written off. So this is the amount that has been charged, right? So 18,000 of depreciation as given in the question, 13,000 of goodwill written off, and then we had a loss on sale of plant which is 3,000, which belongs to some other category. We will add that back, right? Then dividend income of 1,500. Now how much dividend did we receive? We received 2100 of dividend. Out of this 600 was credited to cost of investments. Balance 1500 would have been credited to your profit and loss statement. This is something which does not belong to the operating activity, and hence we have deducted that. Now after this we'll get the operating profit before working capital changes. Then we'll have to do the working capital adjustments. Now whenever you do this working capital adjustments, inventory is fine, trade payable is fine. What do we do for the other current liabilities which pertain to dividend payable and provision for tax? You will not adjust these two under working capital adjustments because dividend payable we consider it separately under the financing activity, and provision for tax will consider separately as a tax paid. Okay, so you'll adjust only inventory and trade payables. Now if you look at the inventories, opening balance is 85, closing balance is 78. So what would you do? You would do opening minus closing. Opening balance is 85, closing is 78. The difference is 7000, which is a positive number. For current liabilities, that is trade payables, opening is 44 and closing is 65. For current liabilities, you will do closing minus opening, which is a positive 21,000. Then income tax paid, this is the actual tax paid, which is nothing but the provision for the previous year. Current year provision will not impact this working, right? So you'll get cash generated from operations. Then from our working notes, we know 134,000 of plant was purchased. Sale of land, the information is directly given in the question. Then we had a sale of plant, 12,000 rupees or worth 12,000 rupees. Then dividend received entire 2100, that is 1500 plus 600. Don't do a mistake of only considering 1500. You have to consider even the part which has been credited to cost of investment because that has been actually received. Then purchase of investment, we had done a working note 25,600, which is straightforward. Then under financing activity, we know we have raised fresh equity of 1 lakh. No other information is given, so you can assume it is for cash. Then redemption of preference shares, the interim dividend and final dividend 10,000 and 27,000. Now you may have a doubt here. Why did not we consider 37,000 here? Because this 37,000 is not yet paid. What we have paid is 27,000 of the opening balance. So only that will be considered as the outflow, right? Once you do this, you can arrive at what is the net increase or decrease in cash and cash equivalents. Compare that with opening and closing. You can present your answer. Generally, there has not been a trend to ask such a lengthy question under cash flow. Generally, we get a 10-mark question which is more simpler. If this question comes, it would be around 16 marks in your examination. The next question is on profit and loss prior to incorporation. Now, this again should be a cakewalk for you. Roshni and Reshma, working in partnership, registered a joint stock company under the name of Happy Limited on 31st of May 2018. So what is the incorporation date? 31st of May of 2018. This is the incorporation date. The summarized profit and loss account is given for 31st of March 2019. Okay. For the year ended, meaning this starts from 1st of April 2018, right? Now, what is the time ratio here? April and May, 2 months this side. June to March, you have 7 plus 3, 10 months this side, which makes it 1:5. This is nothing but your time ratio, right? Now, let's look at the items. Salary, unless no other information is given, we'll do it on the basis of time ratio. Interest on debenture, this is only post incorporation because debenture does not exist in a partnership firm. Then sales commission on the basis of sales ratio, bad debts on the basis of sales ratio. We have to check if there is any other information given. Depreciation, unless any other information is given. Time ratio, it's only for company, so it is only purely post incorporation. Gross profit on the basis of sales ratio. GP ratio or gross profit ratio was constant throughout the year. Depreciation include 1250 for asset acquired in post incorporation period. Now how do you handle this? From this depreciation you will reduce 1250. This is purely post, and whatever is the balance you will split in the basis of time ratio. Then bad debts recovered amounting to 14,000 for a sale made in 15-16 has been deducted from bad debts mentioned above. Now what does that mean? This bad debts, whatever you are seeing here, 49,000, that has been arrived at after adjusting bad debt recovery of 14,000. So what is the actual bad debt? Actual bad debt is 49,000 plus 14,000, which is 63,000. Right? Now this 63,000 you will adjust it on the basis of sales ratio. Now this 14,000, whatever is the recovery, it is an income, and this income belongs purely to the pre-incorporation period, right? Then total sales were 18 lakhs, out of which 6 lakhs were the period April to September. Now what does that mean? From April to September you made 6 lakhs worth of sale. From September to March you made balance 12 lakhs worth of sale. Now when did the acquisition happen? After end of May, that is 31st of May. So if 6 lakhs was made between April to September, how much was made between April and May? For 2 months the sale would have been 2 lakhs. This is the pre-incorporation sale. 4 lakhs here plus 12 lakhs here. This is the post-incorporation sale. So what is the ratio? 2:16, which is nothing but 1:8. Now in this ratio you can compute and distribute those items which are based on sales. Happy Limited had to occupy additional space from 1st of October, for which rent was 2,400 per month. Now what does that mean? Out of this rent of 38,400, 2,400 into 6, this is purely post acquisition, and from the balance you will have to do a time ratio based adjustment. Once you apportion all these items, you can figure out what is the pre-incorporation profit or loss, and then whatever is the profit you will transfer it to capital reserve. The next question is on accounting for bonus issue, which is a very straightforward question. Still we'll just have a quick look at it. It has given authorized capital and issued and subscribed capital, and they have mentioned that equity shares are 8 rupees paid up. Then they have given information of general reserve, CRR, securities premium collected in cash, and profit and loss account balance. Now the company made a final call of rupees 2 each on 2,70,000 equity shares. So for this you will need to pass a journal entry. The money was received by 20th April, that's fine. Then the company decided to capitalize its reserve by way of bonus at the rate of 1 share for every 4 shares held. How many number of shares are held? 2,70,000. This 8 becomes now 10 paid up after the final call. So what is the ratio? 1 for every 4 held. So for 2,70,000, how many will be the shares? It's simply, you can simply do a 2,70,000 divided by 4, which makes it 4 6 24, 367,500 into 10, you get 6,75,000. Now how do you use that? First you will consume securities premium, then you will consume capital redemption, then you will consume general reserve, balance will come from your P&L account. It's a simple question. Moving forward, Omega Company offers new shares of 100 each at 20% premium to existing shareholders on the basis of 1 for 4 shares. The come right market price of the share is 190, right? So what are the number of shares held? What are the number of shares issued? 1 for every 4 held, right? And what is the price? 100 plus 20%, the price is 120. What is the market price? Come rights price is given as 190. The question has asked us to find out what is the value of a right share. For that we need to figure out what is the X rights price or theoretical X rights value. What is the theoretical X right price? Which is nothing but the existing investment plus fresh investment. What is the existing investment? For 4 shares at 190. What is the new investment? 1 share at 120. Total after this will be 5. This is nothing but 760 plus 120, 880 divided by 5, which is 176. Now what is the come rights price? 190. What is the theoretical X right price? 176. What is the value of a right? 190 minus 176. The value of a right is 14. This is a possible 4-mark type of a question. Let's look at the next question, which is on redemption of preference shares. The following are the extracts from the balance sheet of ABC Limited as on 31st December of year 1. Share capital 50,000, equity shares of 10, 5 lakhs. Then redeemable preference shares 2 lakhs. Reserve and surplus, capital reserve, general reserve, profit and loss account. And on 1st January, the board of directors decided to redeem the preference shares at a premium of 5% by utilization of reserves, which means they are not making any fresh issue. If they are not making any fresh issue, you have to transfer an amount from the distributable or free reserves to the capital redemption reserve. Now there are two things here. One, 5% premium. 5% premium on what? On your 2 lakh worth of preference share, which comes to 10,000. This 10,000 will always be debited to the P&L account. The second thing that you have is 2 lakhs, that is the face value of preference share. For this you have to create a CRR, and for creation of CRR you cannot use your capital reserve, you have to use general reserve and P&L. So first preference will be given to general reserve, so that will be an additional entry you will pass by debiting general reserve. So you will debit general reserve and you will credit the CRR by how much? 2 lakhs, that is the face value of the preference shares being redeemed. The next question is on redemption of debentures, whereas the question has not asked anything about redemption, but still there are some requirements related to redemption which we need to fulfill. And the question is, Omega Limited recently made a public issue in respect of which the following information is available. 2 lakh debentures were issued, face value and issue price is 100. Then there is a conversion that is happening. Convertible portion per debenture is 60% and date of conversion is on expiry of 6 months, that is 31st of October. So that is the date of conversion. What does this date of conversion mean? The debentures, to the extent they are convertible, will be converted to equity shares. Date of closure of subscription is 1/5, date of allotment is 1/6. Rate of interest is 15% from date of allotment. Value of equity share for the purpose of conversion is 60. Now the question says 60% of the debentures are convertible. Now out of 2 lakhs, 60% comes to 1,20,000. These many debentures will be converted. Now what is the total value of these debentures? This into 100 is the total value of the debentures. What is the value of equity share? The value of equity share is 60. So how many equity shares will be issued? So this is gone, 6 makes it 2 times 2, 1, 2, 3, 4, 5. So 2 lakhs equity shares will be issued at a value of 60 rupees and face value is 10, which means balance 50 will go to the premium account. So 2 lakh number of shares into 60, which is 1 crore 20 lakhs, that will be debited to the debentures account. 20 lakhs will be credited to equity share capital and balance 1 crore will be credited to the securities premium account. Are we clear? Right? Then underwriting commission is 2%. So out of the total issue of 2 lakhs into 100, that is 2 crores, on that 2% is the underwriting commission. So how much is the underwriting commission now? It comes out to 2 crores into 2%, which is nothing but 4 lakhs, right? Now what will be the entry for this? You will debit the underwriting commission account and you will credit to the underwriters. Number of debentures applied for 1,50,000. How many were issued? 2 lakhs. How many we got application for? 150. The balance 50,000 will be taken by the underwriters. Interest payable on debentures is half yearly on 30th September and 31st of March. So on 30th of September you will pay interest from 1st of June, that is June, July, August, September. For 4 months interest will be paid. Then next it will pay on 31st March for 6 months. Now when you pay interest on 31st March, one thing you need to keep in mind is a part of debenture existed only till 31st of October, from which date we have converted them into equity shares. So interest on that portion will be paid only for 1 month, and on the remaining part you will pay interest for entire 6 months. Or the other way to look at it is, we had total of 2 crores worth of debenture. These were outstanding for 1 month, so you will pay 1 month interest. Then you converted 1 crore 20 lakhs worth of debentures to equity shares, which means only 0.8 crores were outstanding for remaining 5 months, right? So you have to compute interest accordingly. So this will be nothing but into 15% by 12, same thing into 15% by 12. Right? Now with this understanding, let us look at the entries that we are expected to pass. Please note they have also asked us to pass cash and bank entries, so we need to pass starting that. What is the first thing that has happened? On 1st of May the debentures applications were received. 1st of June allotment happened. On 30th of September interest has to be paid. On 31st of March interest has to be paid, and in between on 31st of October there is a conversion that is happening. Let us look at those entries. The first entry, for receipt of application money from 1,50,000 debentures into 100, 1 crore 50 lakhs, 1 crore 50 lakhs. To save time in the examination, you can simply remove this 50 and say amount in lakhs, so that you just need to write 150. and 150. You'll save a lot of time. Then the entry is bank account debit to debenture application account. On allotment, you will debit debenture application account, and underwriters have to take 50,000 debentures at 100. So 50,000 into 100, 50 lakhs will be debited to underwriters account. You will debit debenture application account by 1 crore 50 lakhs. Both of these will be transferred to debentures account. This is the allotment entry on 1st of June. Then you have to pay underwriters commission for 4 lakhs. Now, after you pay or after you credit the underwriters with their commission, the next thing is the settlement to underwriters. Underwriters will have to pay you money. You have to collect 50 lakhs on account of shortfall in subscription, and you have to pay them 4 lakhs. So 50 minus 4, 46 lakhs is what you will receive from the underwriters, right? Then we need to create debenture redemption reserve, and we also need to invest a portion in debenture redemption reserve investment. Now this we can do it on any date before the closure of the financial year, right? So this date it can come later as well. Now what is the requirement of redemption reserve creation? We know it is 25% of redemption value. When we issued debentures worth 100, we know that entire 100 is not repayable. Out of this, 60% will become equity and only 40% is redeemable, right? So out of every 100, only 40% is redeemable, which means 100 into 40, 40 rupees with respect to each debenture. Totally we have 2 lakhs debenture. So out of this 2 lakh debentures, we have to create debenture redemption reserve to the extent of 40 rupees of redemption value. On that, we will need to create a DRR of only 25%. So 40 rupees into 2 lakhs into 25%. This comes to 20 lakhs. So this is your debenture redemption reserve creation by debiting profit and loss account to debenture redemption reserve. Generally, we pass this entry on 31st of March, right? Then 25% is the reserve creation requirement. Investment requirement is 15%, right? If the investment requirement is 50%, again you had 2 lakhs of debentures. Of this, only 40% will be redeemed. Into 100 rupees is the face value, into 15% is what you need to redeem. That comes to 12 lakhs. So 20 lakhs is the redemption reserve, 12 lakhs is the investment. Though they have not mentioned this in the question, these two entries are necessary. Then on 30th of September, we will pay interest on 2 crores worth of debenture for June, July, August, September. So 4 months into 15 divided by 12, that comes to 10 lakh rupees. Then on 31st of October, 1 crore 20 lakhs were converted. So you will debit debentures account, you will credit equity share capital and securities premium account with the numbers that we have already computed. And lastly, you will pay debenture interest on 31st March of year 2. What is the amount for that? We know 2 crores were outstanding for 1 month on this 15 by 12, right? Then 0.8 crores was outstanding for 5 months. So into 15 by 12. So how much is this? 2 crores into 15 divided by 12. So this comes to 2.5 lakhs and this one comes to 80 lakhs into 5 divided by 12 into 15%, that comes to 5 lakhs. So 5 plus 2.5 you get 7.5. So this is the entry for interest. Alternatively, you can assume 80 was outstanding for entire 6 months and 120 was outstanding only for 1 month. Even in that case, you can get 7,50,000, right? Now, apart from this, another entry has to be passed, which is transferring this debenture interest account to P&L. Not only this 7,50,000, but also this 10 lakhs. So there is one additional entry which is missed out in your RTP. You have to debit P&L to debenture interest. Okay, so this is how you will pass the necessary journal entries.